Good afternoon and welcome to the Hercules Site Services PLC webinar hosted by Yellowstone Advisory. We're delighted to have with us today Brusk Korkmaz, CEO, and Paul Wheatcroft, CFO, who will provide an introduction to Hercules, an update on performance following the publication of the half-year results, which were released yesterday. I'm now going to hand over to Brusk to start today's presentation.
Thank you, Alex. Thank you. Thank you so much, everyone, for dialing in and meeting us today. As you might have already seen from our announcement yesterday morning, we had a fantastic first 6 months. Just to summarize, our H1 2023 year-on-year turnover increased by 85% to £37 million, and our year-on-year EBITDA increased by 73% to £1.1 million compared to H1 of 2022. In today's presentation, we'll talk about our performance over the last 6 months, and we'll also share our future growth plans with you. Just to give you a bit of a brief introduction for our company, Hercules Site Services PLC is a technology-enabled labor supply company operating in the infrastructure sector. The next slide is the disclaimer, and this is our board. This slide is about our board members. I'm Brusk Korkmaz, I'm the CEO for Hercules, and I am joined by our CFO, Paul Wheatcroft.
Hello, everybody.
As you can see from this slide, we've got a very strong and well-respected board with both exec and non-exec directors with great blend of experience in infrastructure, financial, sales, banking, PLC, governance, and even starting and running an AIM-listed company. Together, we believe that we can grow Hercules even further. The next slide is about our achievements. As I mentioned before, we had a fantastic first 6 months for 2023. Turnover H1 year-on-year increased by 85%, and we are trading in line with market expectations. Our growth was around 50% for the first 2 years, year ending 2021 and year ending 2022. We increased 50%, as you guys might remember, and we are forecasting similar sort of growth for the year ending 2023. We have seen growth across all of our divisions, and with regards to our labor supply arm, we established 2 new divisions, which are our white collar and our site security divisions. They are already bringing some income towards our turnover, and we believe that these 2 divisions will grow within the next few years. With regards to our suction excavators division, our fleet grew from 16 suction excavators to 30 suction excavators. So now we have one of the biggest fleet in the UK, and we will start seeing increased turnover and profits coming in, contributing for this year's 2023 year's end of year results. We have been paying dividends since we got Hercules listed on the stock exchange, and dividends continue to be paid to our shareholders. And with regards to our last bullet point, as you might be aware, that we are establishing our training academy in Nuneaton, and you already know potentially that there is a skill shortage in the UK, and it is important for us to have a sustainable approach, which is finding local people for local projects, putting them to work, and upskilling and cross-skilling them. We also want to monetize this opportunity as well. Therefore, our training academy plays an important role in this sustainable approach. So our goal is to open our training academy by early 2024. This slide is about our business overview, how Hercules operates. As you can see at the top of this slide, some of our blue chip clients that we work for in the infrastructure sector. As I mentioned before, we are mainly a labor supply company working for our blue chip clients and our blue chip companies, and complemented by our construction services division. Our labor supply department is a significant part of our business, which currently contributes around 80% of our turnover, and this number is still growing. As I mentioned before, that we have added 2 divisions under our labor supply business, which are our white collar and our white security site security divisions. You can see on the left-hand side. Under the construction services division, we hire out our suction excavator services, and we carry out civil projects under the same umbrella. At the bottom left of the screen, you can see our 2 apps that we have developed in-house. There are Hercules recruitment app and our One Team app. Hercules recruitment app helps us to recruit local people for local projects, and our One Team app helps us to onboard them efficiently in a paperless process. At the bottom right, you can see that we have developed a portal called See Everything Portal, which stands for Skills, Education and Employment Portal. And we have developed this product for our client on the HS2 All Documents Station project. And we have already started licensing this out, bringing in an income. As you can see, that our digital arm differentiates us from our competitors and underpins the whole business. Even though we are principally a labor supply company with these numerous services available, the services that I mentioned, one of our biggest USP we've got is that we can cross-sell all these services to our clients under the same umbrella. Paul, I think next slide is yours.
Thanks, Bruce. This is our group statement and shows the comparison of the results from the 6 months just ended at the end of March to the same period in the previous year. So as Brusk has outlined, you can see that the turnover increased 85%, the EBITDA increased 73%, and we're on course to achieve market expectations. We're a very, very busy business, getting busier by the day. And the main point worth pointing out here in terms of the results is that very, very successful growth in EBITDA. The difference between EBITDA and the PBT is the depreciation and finance costs, which almost exclusively relate to the suction excavators, the division that we created almost 3 years ago now, which is now well and truly up and running. We'll come back to that later in the presentation. Labour supply, which as Bruce said is about 80% of our business, had a staggeringly good first 6 months. As you can see on the bottom right, 110% revenue growth. Now, a lot of that is the HS2 northern section, but by no means all of it is. We've got a lot of growth on labour supply in general. There's a lot of activity out there because of the support that's being put into infrastructure over the next 10 or more years. So we've got organic growth really driving all of this through executing really a strong project pipeline. Part of that is gaining new clients. There's 3 there: John Sisk, Galliford Try Highways and CHC Highways, all significant clients that we've gained in the last 6 months. And it's important to keep spreading the knowledge of Hercules to all the major blue chip companies in the country, so that, and we work with most of them now, but the ones that we don't, we're working on changing that all the time. Another interesting point really is HS2 northern section is really run by a labour desk. That's 6 suppliers on the labour desk. We're actually supplying 25% of the requirements. So we're doing more than originally you might think we would. It's not a 6. We're doing a lot better than that, and that's because we can do better than some of our competitors. In fact, we're normally first or second on the list of the highest percentage suppliers here. We think at the moment we've got about 1,000 operatives out on sites, which includes HS2, and that's a staggering increase from where we were a year ago. How do we do this? Well, one of our main USPs is that we have a digital recruitment app, which we think by the time we get to July, we'll have about 10,000 people registered on it. What this allows us to do, and as Brusk mentioned earlier, allows us to find local people for local jobs. So we're matching what their skills and qualifications are to jobs in their locality. This is really important because it's what people want to do. And this no doubt is helping us supply all these people in the way that we are doing to HS2 and to other sites. We've also got the One Team app, which is really how we get people onboarded and get them onto site, started properly with all the correct right to work checks being done. This is really important. But what's really even more important in some respects is that we have to get it done quickly so we can get them on site for the client. And that really needs this digital approach, paperless. It reduces the need for expensive central overheads and traveling to get things done, because you can do it all digitally. In terms of training, this is really, really important in labour supply. Well, not just labour supply, but particularly so here, because training is not something that you do and then you've got it for life. Every 3 or 4 years that has to be renewed, and we have to make sure all our operatives are constantly retrained. So not just our training division operates in a number of different ways. First of all, to try those internal people, but we also do mobile training. We go to other people's sites and we do mobile training for that too. We're also doing work with further education colleges, and that really is where we're going to start to get our first income stream, and that will expand even further. Brusk was mentioning that the training academy, we're really expecting to start operating out of there very early in 2024, and that will be yet another income stream coming into the business. I talked about suction excavators earlier on, so we've started the 6-month period with 16, and we got an extra 4 that came in up until January that were delayed from an order that we placed in April 2021, would you believe, and because of parts problems on the continent, that they were delayed. But we got those 4, and then we got another 10, which was the April 22 order that we placed. They all came in just before the end of March, which is important because those of you who are up on tax legislation will know that the super deduction expires at the end of March. So it was important to get those delivered so that we can get the benefit of that deduction before it disappears. One of the key things with suction excavators is that we make sure we keep the utilization high. And part of that is to make sure that we're constantly gaining new clients. This can be because they've only just recently seen the light and they've decided they want to start using suction excavators rather than mechanical digging, or it could be that they've been doing this for a while but with some of our competitors, and they're coming to us because they know about us, they get to learn about us, they know we do a good job, and the word has spread. So there's a number of them there that you can see on the slide that we've gained in the last 6 months, which is really important. So we've got these 10. We didn't get any revenue from them in the first half year, but we've now got to get them all sorted, get them out, and get the revenue coming in the second half year and beyond. So new clients is going to help to get that utilization up, which will bring good profitability additional profitability into the business. Finally, again, I'm not too much of a technical person myself, but I can tell you that I know what a triple fan is. A triple fan is technology we have on 2 of the suction excavators that we had delivered in March. They're more powerful than anything else, and they can suck even deeper down and more powerfully. And there is an increasing requirement on sites in the UK for this sort of technology. There's not many people who've got it. We've now got it with some of these, so we'll be looking to utilize that technology and to get some premium prices for that sort of capability that we can offer. It's worth saying that we've spent since August 2020, when we started with suction excavators, we've spent some considerable time and money building this fleet, now up to 30. But we have no plans to go any further than this. We think this is our sweet spot. It's our sweet spot because to go above 30, considerably more investment would be required to manage that sort of a business. We think we can make this really, really sing over the next year. We can get this really, really super efficient, fully utilized, and generating, reasonable amounts of cash. As obviously as well, we'll be paying down the debt that we've taken on for to buy the suction excavators in the first place. So another year of repayments will reduce that debt considerably. So that's our plans with suction excavators. Civil projects is the third strand of our business, and this is where we quote for priced jobs in the water and sewage sector. We work very significantly in the asset management program, which is currently AMP7. But in the first 6 months, we had a cracking first 6 months, 30% increase in revenue, very, very busy. And we've currently got contracts in the book, which we're working on, which will have a value of 10.1 million in this financial year. So we actually achieved 12 million in the last financial year. So we're well on the way to at least matching that in this year, but more likely just slightly eclipsing it. We finished and completed actually 20 projects in the first half of 2023. And we also gained, again, as we have been doing with the other business sectors, we've gained new clients. So we gained Amy and SGN into the civil projects division. Really, really good for the future, both very strong businesses and will generate quite a lot of work for us. Having said that, we're cautious on what work we take on in this division. We could do an awful lot more, but this is where there's the risk element comes into the business. So we want to therefore keep that under control. And we've controlled that very well in the last few years since we started doing price works or civil projects. What we try and look for is the highest margin projects with the lowest risk. Also, projects that we know we can do and we can do well. That's what we look for, and that's how we control this. Onto the balance sheet. So this is the balance sheet, and it shows the comparison of the same point in the previous year. So the assets, the top half of the balance sheet, are the fixed assets, which mainly the suction excavators, but we've also got property leases, which, as you know, we have to capitalize under IFRS. The current assets include the debtor book, which has increased significantly as per the turnover increase. In the bottom half of the balance sheet, you've really got three lots of debt there. One is the assets, the suction excavators, which I referred to, which I think made up about 13 million of that element at the end of March. You've got the debt on the leases, or the balance on the leases, which is about almost £6 million. And then we've got an ID facility. So for those who don't know what that is, that's an invoice discounting facility, which effectively allows us to contribute to our working capital requirements. And I think at the end of March 2023, that was about 8.5 million. So that's the nature of the balance sheet, how it's made up. Cash flow. So we ended the 6-month period with 2.6 million in cash. A year before that, we were 1.6 million. We had a fundraise in January of this year, which some of you will be aware of, where we raised £1.6 million. That was really for working capital, and without boosting working capital, we wouldn't have delivered the fabulous results that we did in the first half year. Nature of our business is that we're working capital hungry, and you don't grow 2 years for certain, 3 years, third year most likely, you don't grow 50% every year without serious changes to your working capital structure and also to your internal management and governance structures. We still paid our dividends. We've been paying dividends since when we started after the IPO, and we fully intend to continue that trend. So we paid our full year dividend for year ending 2022. We paid that in March, and we're planning to pay another interim dividend for 2023 in August of this year. So that's a summary of where we are on the cash flow. Brusk, I'll hand back to you now.
Thank you, Paul. As you can see from this slide, we have multiple growth opportunities for our growth plans. First one is the organic growth. We have been explaining to you, we have seen organic growth across all the divisions, all of the 3 divisions, through our strong pipeline of projects into H2 of financial year 23 and 24. With regards to our training and training academy, we are targeting a new revenue stream for upskilling and cross-skilling our workforce. We also want to sell the construction-related training to the colleges, to the blue chip clients, and also individuals, as well as to our competitors. With regards to the white collar and our site security divisions, we have got one manager appointed on each side of each part of the business in November last year, and this has been growing, and we believe that they are going to contribute towards our revenue and EBITDA, and that is going to increase in the next few years. And the digital arm, as I mentioned, we managed to monetize our C portal, and we want to push that to other blue chip clients, as well as to the projects as well. And the suction excavators, we want to see the benefits from the expanded fleet and increased utilization. We've got 30 now, so we are going to see an increase on the EBITDA and the turnover as well for the second part of the year. As Paul explained, we have got another 10 suction excavators that we have got at end of March. With regards to the subsidiaries and partnership approach, this will help us to accelerate our labor supply growth into new geographies and new sectors by partnering up with ambitious managers. As you might already heard, a company called Mighty PLC, they started this approach and they grew quite a lot. And we believe that this is very suitable for our labor supply labor supply division, for us to have this sort of approach. And we are talking to few potential partners to start 1 or 2 this year, or beginning of a second year, beginning of our next financial year. With regards to our M&A activity, we are already talking to identified acquisition targets in the labor supply sector. Sorry, we can only tell limited amount about this, but we are talking to companies with synergies to help us grow our turnover and our profitability in different construction sectors. We've got one more slide left. So this is about our investment case. So why invest in Hercules? As there are over 1,000 companies listed in the London Stock Exchange. We believe that we have a really good investment case and a fantastic story. With regards to the first bullet point, sustained track record of growth, we haven't been only just growing for the last couple of years. We've been growing since I started the business 15 years ago. And we have been growing year on year. The reason that we came to the AIM market, we want to grow even more, and we want to have this. We are very excited to be on this platform, and we believe that this platform is the right platform for us to grow and help us with the potential acquisition opportunities in the future. As we have explained, positive performance across all divisions and strong momentum has continued into 2023. And we have got significant cross-selling capabilities between the departments and between our divisions, and that really helps us to capitalize in the market. There's a huge market opportunity. As you are aware, there is a massive investment in the infrastructure sector, in the rail, in the highways, as well as now the nuclear energy power plants are coming into it as well. So we believe we'll be busy next 15 years plus in operating in the infrastructure sector. So we are well placed to gain the market share. As I explained in my previous slide as well, we've got a defined strategy with multiple growth opportunities as well. Thank you so much for listening to us, and really appreciate dialing in. Yeah, we would like to take some questions as well, please, if that is possible.
Brilliant. So Brusk and Paul, thank you very much for that presentation. And
Thank you,
Brusk said, we are now going to take some questions. So here's your opportunity to ask Brusk and Paul any questions that you have. And if you do want to ask a question, please type it into the chat box at the bottom of your screen, and we'll try and cover all the questions. And just while you're typing your questions in, I'm going to ask a couple that have come in ahead of time. And the first one I think really is for you, Paul. It's on the balance sheet, and it's the question is, the receivable number of 18 million looks quite large compared to revenues of 37 million, and suggests it takes about 180 days to get paid. Are there any risks that some of those receivables aren't paid? And could you comment just on the working capital cycle?
Sure. Thanks, Alex. Yeah. So the terms with our clients typically between 45 and 60 days, and we actually on average achieve those payment days. So the growth in receivables, the sort of like the way you look at receivables against sales isn't necessarily any sort of a guide. So our debtors are quite under control. In fact, they're probably as good as they've ever been currently. We had a big increase in activity as everybody came out of the Christmas period, which would have boosted the receivables in the balance sheet, because you don't get paid till later on. So that would contribute to the way that those numbers look. But this is really part of a growing business. So we in terms of working capital, I think I mentioned during the presentation that we manage working capital mainly through an ID facility. So we've got a good facility, and that's grown with us, and we want that to continue to grow with us, to help us manage the further growth that will no doubt come. So in terms of are we concerned about any of those receivables? Well, we've only had one bad debt hour in entire history. That wasn't in labour supply, it was in another element. And we do our absolute best to make sure we only deal with very reputable clients, and we don't go for any of the small operators. We don't want to take those sorts of risks. And a lot of, if you think about it, most of our work is funded by the government. So the government go through main contractors, and then we work for them. So you can never say there is no risk in getting paid, because every business runs the same sorts of risks. Do we think we've got some high risks? No, we absolutely don't think that at all. And we believe our controls are as good as they can be to manage that process.
And also, just to add as well onto that, we have got project accounts set up as well for the big contracts, such as HS2 or the national highways projects. As government want to have a control of, if any of the main contractors go bust, they want to step in and honor the payments and business as usual. So there are a few ways that we mitigate this risk.
Okay, thank you. I've got a question here. Again, looking at the finances here, I thought there might be some operational gearing in the business, but that doesn't appear to be the case in these numbers. Could you comment on that?
Okay, sure. I'll cover that one off again. Bruce, you add anything to it you think I've missed. We've been building the business considerably over the last few years. I think we knew before COVID struck we knew that there was going to be significant growth in the business. And at that point in time, we were a relatively small private company with a very lean management and overhead structure. And we knew that as this growth was going to come through, we'd have to start to build those structures. Now, we've been doing that. We've been doing that for a number of years. And it goes wider than that because, of course, becoming a PLC adds another level of cost into the business with non-executive directors and brokers, PR people, etc., etc. And we've had to build into the way that we operate. The other element here, of course, is Suction Excavators. So Suction Excavators was a new business from August 2020, and we have to build with each vehicle comes its associated costs. And it's not, I don't just mean cost of sales here. I mean things like insurance and maintenance and the teams of people to actually work with the clients to get this fleet out. So we've been building all these elements of our business in terms of structure over the last few years. Now, we're at a very interesting point now because we've got to March 2023, where, as I said earlier on, we're not intending to build the suction excavator fleet any further. So we expect our overheads to the growth to level off from here on in. We think we've built a team, we've built some structures that will work well with us for the next few years in terms of growth. Beyond that, it's harder to say, but we've been building towards this on purpose to get this level of infrastructure internally so we can manage this growth that's coming and that we've got so far. But that growth is going to level off now. So from that point of view, we would expect any additional turnover and EBITDA that starts to come into the business to really start to show quite heavily in the PBT line.
Okay, thank you. Question here on High Speed 2. What proportion of revenues are linked to High Speed 2, and what is the impact of delays to the Euston terminus and to the stage from Birmingham to Crewe?
Shall I start with the second half of that question, if that is okay? With regards to the delays, we are not seeing any delays on our section because we work on the northern section, which is currently committed and it has already started. With regards to the HS2 Euston and from Birmingham to Crewe sections, I think there is a delay on them because of the inflation being high. So the section from Birmingham to Crewe, we weren't going to start within the next 2 years anyway. So our current section is business as usual, and once we are sort of, it works out better for us actually, because when we are sort of finishing the Birmingham section, we will be ready to move our people from Birmingham to Crewe, which will be probably starting within 2 to 3 years time. So we weren't forecasting on any of those numbers. And with regards to the Euston station, we haven't been working on that section anyway. So we have got minimal effect and business as usual for us. With regards to the contribution, Paul.
Yeah, I mean, in the 6 months just ended, I think if I remember right, the HS2 element of turnover was something like 30% of it.
Okay, thank you. Question here about your growth. You commented that you'd had 2 years of 50% growth in revenues, and then in the first half of this year you grew revenues by 85%. Are you expecting revenues to slow a little bit in the second half to get you back to that overall 50% growth level, or are you expecting growth to come in at a similar level as you've experienced in the first half?
I think the 85% growth in the year on year of the first half, I mean, obviously we are a hell of a lot busier, but also there's some mathematics here of growth. So we were obviously seriously smaller in the first half in the previous year, as well as that. Everything we're very a bit like football, we're a game of two halves in terms of our financial year. So obviously the first half of the year has Christmas in it, and the second half of the year has the summer in it. So that skews everything quite a bit. On top of that, we're obviously going through periods where we've got big changes in the business, not just this year, but the previous year as well. So we were having suction excavators delivered at different points last year. We are this year as well. In the same way, HS2 and other labour supply sites, which are all very, very busy, of adding extra people to them all the way through this period. So we think we're going to have a very good second half year. Where what the figure will turn out to be, I don't know, but we're trading in line with market expectations, and I think what I can say is that we're very confident that we will, if not achieve that market expectation, but beat it.
Okay, thank you. Got a question here specifically on the suction excavators. Can you talk about the utilization rates of the suction excavators? You know, where were they in the first half, and where would you hope to get to them in the second half of the year? And I guess just could you explain how the 10 new suction excavators sort of come into that sort of picture?
Are you going to do that one, Brusk, or shall I?
Yeah, if you don't mind starting, Paul, I will.
Yeah.
I will. Yeah.
Yeah. So we've been building this fleet, as we've said, since August 2020, and the key to it, and we've always known, is utilization. And every time we get a new one, and we're used to the process now because we've been doing this for a while, you have to get the vehicle ready. You have to get trained operatives ready to go in them so you can send them out to clients. And that's the process, and that's the timeline. And you have to get make sure you've got enough clients to actually fill that, so you get the benefit of it. And we've been quite successful at this. And so far, over time, we've averaged up until, you know, this 10 have come. So we've obviously got a different challenge now in the second half year, because we've never had 10 delivered all in one go. And that was really so that's a challenge to us. But up until then, we've achieved on average about 80% utilization, and that goes up and down at different times in the year. In the summer months, it can sometimes be very high because you can get double shifting, you can get night shifts. Whereas in the Christmas period, that's always difficult in construction. Generally, it's lower than that. But on average, we've been achieving about 80%. So the challenge now to us, and this is what the team are working on all the time, is how can we now get up to the same level of utilization, including the 10 new ones. I think I said in the presentation that part of that is additional clients, new clients, which I think I gave you a list of. Part of that is making sure we've got enough operatives ready to be recruited, to be trained, to be ready to go. And then just really making sure that the activity level is achieved. There's always going to be a time lag before you get back up to that, but we certainly hope to get up to that within the next on those additional 10 within the next few months, and certainly by the end of the financial year, we'd like to think that we're well and truly getting that to be really efficient and really singing.
Just as a small point as well, up to January, we had 16 suction excavators. And 14 arrived this year, so far, this year, 2023. So it's a good challenge to have, and we are building towards it. Like Paul said, our aim is to achieve that 80% again, and we are moving in the right direction day by day.
Okay, thank you. I've got just one last question here, but as a reminder, if you do want to ask a question, please type it into the chat box. And the last question here, it relates to the training academy. Could you explain how the training academy becomes an external source of revenue? It sounded originally like it was just for training your own operatives. How will you be using this to train or generate revenue from other people?
Yeah, great question, actually. So with regards to our training academy, we believe with regards to the coming out of European Union, and some of the workforce left there, and some of the workforce retired after during the COVID, workforce, very experienced workforce who are 50-year-old plus, decided to go somewhere else. So we believe that, I mean, there is a massive skill shortage. And in order to, in the UK, and in order to retain the workforce, and also in order to attract more people, we believe training is the key to get there, because of the infrastructure span within the next 15 years plus is immense. So the training academy also gives us a bit of an extra avenue to recruit more people, as well as we are not only a training provider. We can attract, when we attract people there from colleges and other places and apprentices, we can also give them a work at the end of it. So we are becoming this sustainable, adopting this sustainable approach. We are becoming a one-stop shop, which we believe it is such an important point to have. And there aren't any competitors or any of the companies that we know are doing this sort of approach. So we believe that by cross-skilling and upskilling our workforce, so we are going to retain them, and we're going to attract more people coming into the business. But also, when they are having a career opportunity going up the ladder, they're going to get better sort of rates, better payments, better wages as well, which is brilliant thing to achieve for our workforce. But also, we are targeting for extra revenue the colleges, the councils. There are lots of grants available as well for training, or people who want to have a career in construction, because construction is not as before just digging outside in the cold. There are so many exciting opportunities with drones coming into the construction operations. Electric vehicles plants without the operators, that you can do it remotely. So it's becoming such an exciting place for, I would say that I'm a civil engineer, I'm really passionate about it, but for people who haven't had experience in construction, so they want to have a career we are seeing that they want to have a career in construction. Also, people that are, I think, changing as well from retail sectors over COVID into construction as well. That retail, I think, had a bit of a knock, during COVID, and we are seeing people coming towards that. Housing slowed down, people coming out of housing, coming into infrastructure. So we have got lots of opportunities to be able to monetize this opportunity. Also, I don't know if you know as well, in construction, the qualifications do not last forever. So every 2-3 years, depending on what you have got, all the way from first aid training to a dozer operator, you need to keep renewing every so many years. So there are opportunities as well to be able to monetize doing that. With the training academy, what we want to do is that we don't want to just stick to the certain amount of training, and that's what we are doing. We want to evolve with time. So if there is railway, HS2 earthworks will stop in the future, and then the latent tracks will start, and overhead cables will start. So we want to be able to offer them in the future, and having that approach, of flexible approach, will give us better chances to be able to monetize this even better.
Thank you, Brusk. Well, it sounds like a brilliant project, and great for the company, and also for all the operatives that come through it, and they're able to upskill and improve their skills and potentially their revenue earning potential. So congratulations on bringing that to the fore.
Thank you.
This does actually bring us now to the end of today's webinar with Hercules Site Services. Thank you to Brusk and to Paul for presenting so clearly, and congratulations to you both on the performance of the company in the first half. And we look forward to a strong second half again. So look, thank you again. And before people leave, can I just mention a couple of things? Firstly, there is a survey to complete as you exit today. It'd be really appreciated if you could spend a couple of moments just completing those questions. I know management find that feedback helpful. And I do want to just flag up 2 webinars that we've got coming up in a couple of weeks' time. Firstly, on the 19th of June, we've got castings, and then on the 20th of July, we have Halma PLC. So thank you again to Brusk and to Paul, and we hope to see you all again soon.
Thank you, Alex.
Thank you. Bye.
Thank you, everyone. Thank you. Bye-bye.